look at your portfolio right now. Like, really look at it. Are you staring at a falling trend, flashing sales signals, or maybe a strong buy that just seems incredibly undervalued?
Honestly, it's usually a mix of all three if you're looking at the banking sector right now.
Right, exactly. And today, we are staring down a stock that embodies literally all of those contradictions at once. I mean, it's wild. We're talking about SoFi Technologies.
Yeah, SoFi. It really is the perfect storm, you
Yeah,
know? It's this crazy mix of market psychology, algorithmic trading, and just a fierce fundamental debate.
for sure. So to set the stage, today is April 20th, 2026.
Yeah.
And if you look at the ticker, SoFi, the stock is down over 30% for the year.
Which is a massive
A
haircut.
huge haircut. But then it just experienced this wild, like 16.96% short-term relief rally.
Yeah, out of nowhere.
Right, sitting right at $19.50. So the big question for you, the listener, is this a value trap just waiting to crush retail investors, or is this a misunderstood giant finally finding its footing?
That is the multi-billion-dollar question.
Exactly. And we've gathered a massive stack of sources for you today to figure that out. We're talking recent SEC filings, the raw quantitative data from Tickeron, a whole flurry of Wall Street analyst notes, and the full text of that infamous Muddy Waters short report.
Oh man, that report. We are going to tear all of it apart today.
Yes, we are.
We'll look at the balance sheet, decode the insider trading activity, break down the technical signals on the charts, and unpack this fierce, almost tribal battle between the analysts.
It really is tribal at this point.
It is, and we're doing all of this because we are just days away from their critical Q1 earnings report dropping. That hits on April 29th.
Right around the corner. Now, before we really unpack this, I want you to do me a favor. Make sure to like this video, subscribe to our YouTube channel, and you absolutely must leave us a comment with your feedback.
Yeah, we want to know where you stand.
Tell us if you're buying or selling after you hear the facts today. Mentally lock in your prediction right now. And remember, we are just analyzing the data here. This is a human debate. We're looking at market mechanics, but this is absolutely not financial advice.
Right, exactly. We're just mapping out the battlefield here, not telling you where to deploy your capital.
Exactly. So let's establish that battlefield. We have to understand the current reality of the stock price before we can understand the mechanics of, why it's actually moving.
Makes sense. Start with the price action.
So the latest quote is $19.50. It's up a tiny bit today, like a 0.36% daily change, nothing crazy.
Just kind of chopping around?
Yeah. But when you zoom out to the 52-week range, the volatility is just staggering.
Yeah.
We're talking a low of $10.49 and a high of $32.73.
I mean, seeing a swing of that magnitude in a multi-billion-dollar financial institution is extraordinary.
It's completely wild.
It implies a massive identity crisis, really, regarding what this company actually is. Wall Street doesn't know how to price it.
All right, it's like they can't decide if it's a bank or a tech startup. And the short-term trend is very bullish, right? We just saw this V-shaped recovery with a nearly 14% jump in a matter of days.
Yeah, that 13.9% spike was aggressive.
Super aggressive. But then the medium-term trend is painfully bearish. It's trading roughly 55% below its November highs. It has been heavily underperforming the broader market, like the S&P 500, this entire year.
And
It's like jumping on a trampoline at the bottom of a canyon. Like, sure, you're bouncing high right now, but you're still stuck way down in the valley compared to where you were in November.
that is a perfect analogy.
Yeah.
Because that recent 14% jump is fascinating. It wasn't driven by, a traditional earnings beat or anything.
Right, it was news-driven.
Exactly. The catalyst was SoFi's integration with FedNow and the launch of what they're calling big business banking.
Okay, I want to dig into the mechanics of that.
Yeah.
Because on the surface, FedNow integration sounds like a super boring back-end update. Like, oh, great, the servers are faster.
Right, it sounds like an IT patch.
But if we're looking at corporate treasury logistics, instant settlement completely changes how a large company manages its cash flow, doesn't it? I mean, why does FedNow matter so much to the average investor?
It changes literally everything. Look, historically, the market viewed SoFi primarily as a consumer neobank.
Like an app on your phone.
Exactly. A slick app where millennials go to refinance their student loans or, open a personal credit line to buy a couch.
Right, which carries heavy consumer default risk.
Tons of risk. But integrating with FedNow, which is the Federal Reserve's instant payment infrastructure, that allows SoFi to process real-time payments 365 days a year.
Oh, wow. So meaning corporate clients don't have millions of dollars just locked up in digital transit over a 3-day holiday weekend.
Exactly that. The velocity of money just increases exponentially.
That's huge for a business.
It is. And this attracts massive corporate clients who need to move significant capital instantly. The reason institutional buyers flooded in and spiked the stock 14% is because this shift generates high margin fee revenue. Fee revenue. So it insulates them a bit. Fee revenue from payment processing doesn't carry the same default risk as just handing out unsecured personal loans.
You nailed it. It signals that SoFi is trying to build the actual plumbing of the financial system. They are shifting from just a consumer app to a full-blown platform bank.
Which diversifies their income statement away from purely interest-driven revenue, which is vital in this fluctuating rate environment.
Very vital.
Okay, so that totally explains the short-term momentum. The narrative is shifting, but we need to look under the hood, like at the balance sheet and the actual cash flow, to see if the core business is stable. Because hype is one thing, ledger balances are another.
Well, the fundamentals present a very compelling argument against that 30% year-to-date drop, I gotta say.
Okay, let's look at the actual ledger. SoFi currently has a $24.87 billion market cap.
Not small.
No, not at all. And looking at the annual and quarterly income statements, they just hit their 9th consecutive quarter of profitability in Q4 of 2025. They posted a record $1.1 billion in revenue and $174 million in adjusted net income. That's massive. I mean, hitting 9 consecutive quarters of profitability, that transitions a company from a pure growth narrative where they're just burning cash.
Right, the typical startup phase.
Exactly. It moves them to a proven execution phase.
And the forward guidance reflects that execution. For this upcoming Q1 2026 report, EPS is guided at $0.12. For the full year 2026, they're guiding for dollars and 60s.
Solid numbers.
Yeah. And when you look at the balance sheet, their debt-to-equity ratio is sitting at 0.17, and their net margin is a healthy 13.34%.
And just to put that in context, maintaining a debt-to-equity ratio of 0.17 for a bank that is operating in a high-rate environment is remarkably conservative.
Wow, really?
Yeah, it shows they aren't relying on, dangerous leverage to fund their asset growth. They are building a fortress balance sheet.
Which makes the internal corporate behavior so baffling to me.
Oh, the insider trading.
Yes, the people inside the building are sending wildly mixed signals. The insider trading activity here is a complete tug of war.
It is arguably the most confusing aspect of the stock right now.
On one hand, you have the CEO, Anthony Noto. In March of 2026, he bought $1.5 million in stock on the open market.
Which is a classic bottom call. He's putting his money where his mouth is.
Right. But on the other hand, the chief technology officer and the executive vice president have sold over $15 million worth of shares in the last 90 days. Okay, wait. If the CEO's buying, that's great. But if your top tech guy and your VP are dumping $15 million worth of shares, isn't that a massive red flag for retail traders?
The optics are jarring, certainly. I totally get why retail traders panic when they see that.
It looks like they're fleeing a sinking ship.
It does, but let's apply some logic and nuance to corporate compensation here. Executive compensation heavily relies on restricted stock units, or RSUs.
Okay.
When those RSUs vest, it triggers a massive tax liability for the executive.
The IRS comes knocking.
Exactly. So these executives are likely utilizing 10d5-1 plans to automatically sell a portion of those shares just to pay the tax bill. It's not necessarily a lack of faith in the company. It's just a tax disposition or basic profit taking.
Okay, I hear you. But when quantitative funds and algorithmic trading bots scrape those SEC Form 4 filings, they don't care about the nuance of tax liabilities, do they? They just see $15 million in sell pressure.
You've nailed the mechanical impact. Algorithmic trading models weigh insider selling as a negative momentum factor, period.
They just read the raw data.
Right. And retail traders, reading forums and news alerts, they react emotionally. They see the CTO cashing out and assume the tech platform is broken.
Yeah, they assume the insiders know something terrible.
Exactly. It creates artificial downward pressure that fights directly against the CEO's $1.5 million vote of confidence.
The market hates ambiguity. And when the CEO is shouting buy, but the lieutenants are filing massive sell orders, it fuels the exact volatility we see on the charts.
Completely.
And that internal conflict perfectly mirrors the absolute cage match happening on Wall Street over SoFi's actual valuation.
Oh, the valuation debate is the true core of this entire deep dive. Everything hinges on this.
Let's get into it. SoFi has a trailing 12-month PE ratio of 50.57x. Analysts note it trades at 34x forward earnings.
Keep going. What's the sector median?
The banking sector median is 11x, trading at 50x earnings when the rest of the banking sector is at 11x. That's like paying Porsche prices for a reliable Honda Civic just because it has a really cool touchscreen on the dashboard.
That is exactly how the bears view it.
Is the flywheel really worth that premium? Because fair value cash flow models actually price the stock way lower, around $14 to $18.
Right. The bulls defend that massive sauce level multiple by pointing to the financial flywheel.
Okay, how does that flywheel actually lower customer acquisition costs mechanically? I hear that buzzword all the time.
It is brilliant from a marketing efficiency standpoint, I have to admit. So a user downloads the SoFi app for a free utility, like checking their credit score.
Right, something low friction.
Exactly. The acquisition cost for that free user is incredibly low. But once they are inside the ecosystem, the cross-selling begins. The app nudges them to open a high-yield checking account.
Makes sense?
Once their direct deposit is set up, it suggests opening a brokerage account to buy stocks. Years later, when they need a mortgage, the friction to use SoFi is basically zero because all their financial data is already integrated into the platform.
Oh, I see. So the initial cost to get them in the door is pennies. But over a decade, they use 5 different massive products. So the customer acquisition cost shrinks relative to the lifetime value of the user.
Precisely. And the volume proves it's actually working. They're adding roughly 1 million new members every single quarter.
1 million a quarter. That's insane.
That exponential user growth is the entire bull thesis. You aren't valuing a stagnant regional bank with brick-and-mortar branches. You are valuing a hyper-growth tech platform that is capturing a younger demographic's entire financial life cycle.
Okay, I get the bull case. But the bear case, the reason those fair value models drag the price down to $14 is built on a terrifying allegation. We have to talk about the Muddy Waters short report.
We do. This is the dark cloud hanging over everything.
Muddy Waters alleges that SoFi is utilizing financial engineering to hide their real charge-off rates. SoFi reported a charge-off rate of 2.89%, but Muddy Waters claims the real underlying rate is actually 6.1%.
This is the existential threat for SoFi.
If they are masking a 6.1% charge-off rate under a reported 2.89%, they aren't just taking on bad risk. They must be actively restructuring those bad loans to keep them off the default list, right? Which means their recent earnings beat is basically an accounting mirage.
You've hit on the exact mechanism of the allegation. So a charge-off is a loan the bank admits it will never collect. It's a total loss.
The borrower is gone.
Right. Muddy Waters points to mechanisms SoFi is allegedly using, like loan forbearance or aggressive term extensions.
Walk us through how that works on the actual balance sheet.
Okay, so if a borrower stops paying a 36-month personal loan, instead of officially defaulting them and taking the 100% loss today, the bank might offer a forbearance period or extend the loan to 60 months to artificially lower the monthly payment.
So technically, on paper, that loan is still active.
Exactly. It suppresses the reported 2.89% default metric for the current quarter. It makes the math look clean.
But the borrower is still broke. The money is still gone.
Exactly. It merely delays the inevitable capitulation. If the true delinquency rate is actually double what the market believes, that means a massive wave of defaults is silently building up behind the dam. When those loans finally fail, the losses will rip through SoFi's balance sheet and absolutely obliterate their profit margins. That represents the worst-case continuation lower for the stock.
If Muddy Waters is right, the $14 fair value might actually be optimistic.
It could go much lower. Add in fierce competition from traditional banks who are fighting back with their own tech, plus massive neobanks like New Holdings, and the downside risk is severe.
That structural threat totally explains the absolute standoff in the analyst ratings right now.
Yeah.
I was looking at the breakdown, and it's perfectly fractured.
Oh yeah, nobody agrees.
50% of analysts say hold. Just wait and see. 35% say buy, with price targets pushing as high as $31.1 or $38. And then 15% are issuing sell ratings, targeting a drop back down to $18.
The bulls are buying the flywheel metrics, and the bears are trading on the Muddy Waters default allegations. It's that simple.
And that psychological war is literally drawing battle lines on the charts.
Yeah.
Having established all this fundamental war of words, let's look at how the actual algorithmic and retail trading mechanics are reacting on the charts right now.
Let's do it. The charts are flashing conflicting signals, completely mirroring the fundamental debate.
Okay, where do we start?
Let's look at the moving averages first. SoFi is currently trading above its 20-day simple moving average.
Okay, so short-term bullish.
Right, that confirms the immediate short-term bullish strength we saw with the Fed Now rally. Buyers are in control of the tape today.
But the larger context is much heavier, isn't it? The stock is trapped well underneath the 200-day simple moving average, which is looming way up at $24.05.
Yeah, being under the 200-day SMA is the textbook definition of a lingering long-term downtrend.
It acts as a massive technical ceiling. Every time it gets close, it gets swatted down.
Exactly. And the momentum indicators are also showing friction. The RSI is pushing 67, getting dangerously close to overbought territory.
Right.
But on the flip side, the Mass ED just flashed a positive bullish crossover.
So momentum is fighting gravity right now.
The order book shows exactly where that fight is happening in real time. We have clearly defined support and resistance zones. Downside support is really strong between $19 and $19.15.
So buyers are consistently stepping in there to defend the trend.
Right. But looking up, the resistance is brutal. There is a brick wall of selling pressure at $19.44 and an absolute massive psychological fortress at $20.
That $20 mark is so hard to break. We also have a massive warning light from Tickeron. Their profit versus risk rating for SoFi is a terrible 94 out of 100.
Ouch.
Yeah, warning that the extreme historical volatility just doesn't justify the mathematical probability of a clean breakout.
That risk rating really highlights the danger of market microstructure.
So I have to ask, on behalf of the listener, if I'm a retail trader and I see the MACD crossover signaling buy, but I also see that massive sell wall at $20 and the terrible risk rating, how do I not just get chopped to pieces here? Isn't this the textbook setup for a value trap?
It absolutely is.
Like institutional money will just use the retail buying momentum as liquidity to exit their own positions, right?
That is precisely how a retail trader gets destroyed here. Let's walk through it. Say retail buyers get excited by the Fed now news, right? They rush in, pushing the price toward $20.
FOMO kicks in.
Exactly. Institutional algorithms, or that 15% of the market holding short positions, they see that retail volume coming in, and they stack limit sell orders at $19.99.
Oh, man.
The retail buying absorbs the institutional selling, the price gets aggressively rejected at the $20 ceiling, and then institutional momentum fades.
And the floor gives out.
The price collapses back down, leaving the retail trader holding a 10% loss in a matter of hours.
The ultimate fake out. So what breaks the cycle? Outline the actual best-case recovery scenario for the bulls versus the worst-case plunge for the bears.
Okay, the best-case recovery structurally requires SoFi to not just drift above $20, but to violently smash through that 200-day moving average at $24.05 on massive, undeniable volume.
They need a catalyst.
Right. It needs an earnings report on the 29th so undeniably good that it forces the short sellers to capitulate and buy back their shares to cover their losses. That short squeeze would invalidate the long-term downtrend completely.
The worst-case scenario, the continuation lower.
The current rally exhausts itself right at that $20 resistance, the volume dries up, and the sellers take total control. If the stock breaks below that $19 support zone, especially if earnings reveal that Muddy Waters was right and charge-offs are actually spiking, the floor drops out.
The free fall.
Yeah, the stock would likely plunge rapidly toward those $14 fundamental fair value estimates.
We are looking at an incredible dichotomy here. In the short term, this is a volatile momentum play, heavily fueled by the hype of Fed now, the big business banking narrative, and the intense anticipation of Q1 earnings.
It's all adrenaline right now.
Right. But long term, it's a highly valued tech company trying to prove its identity as a bulletproof platform bank, all while defending itself against devastating allegations about its core lending practices.
The April 29th earnings report is the ultimate catalyst. It will force the market to pick a narrative once and for all.
Well, I promised a final provocative thought for you to chew on before that earnings drop, something that builds on all these sources but wasn't explicitly debated. Consider the larger M&A landscape in the financial sector right now. Legacy banks are absolutely desperate for younger demographics and modern tech stacks.
Oh, the consolidation angle. That is fascinating.
Think about it. If SoFi proved the Muddy Waters report wrong, if their charge-offs are truly contained at 2.89% and their financial flywheel continues adding 1 million users a quarter, they justify their tech valuation. But in doing so, they become the ultimate turnkey acquisition target for a massive legacy institution like Chase or Bank of America.
Wow. Yeah, they do.
The question isn't just whether SoFi survives as a standalone bank. The question is, are we watching a bank being built? Or are we watching a spectacular user base being prepped for an eventual premium buyout?
If the underlying loan book is clean, the tech infrastructure they've built makes them incredibly attractive to an older bank struggling with digital transformation. Earnings next week won't just be about revenue, it will be an audit of their foundational value.
So as you look at your portfolio and consider the 200-day moving averages, the massive short interest, and the fundamental battle over those charge-off rates, what do you think is going to happen? Has your prediction changed after hearing the facts? Let us know in the comments below. Thanks for diving deep with us.